Here, this was for the show today.
Is that not
You
Greenspan?
better know who this is.
Is that Greenspan? No, it's Volcker.
Thank you. You can't see all 6'7" of him in this photo, but Jerome Powell is doing his best Paul Volcker impersonation. What else stands out about this photo to you?
Is that a cigar in his hand? I can't tell.
Yeah, dude, he's in the middle of testimony about interest rate policy in 1982, and he's just smoking a stogie.
Well, it's probably not a very fun time to be in front of Congress.
So for that, I brought my own cigar. No, I'm kidding. I didn't do that. I thought about it. Imagine I started smoking a cigar.
I'll go get the fire extinguisher.
Oh, that would be looked on not fondly, I feel.
What is this, the 80s?
Dude, so that's it. He's going 75, man. This is what's happening. 70s like policy. Although, are we back in the 70s, Brett? I have no idea. I don't think so. I'll tell you, let's go after World War II. I think this is more after World War II. What happens with monetary policy every time we go into a war-like scenario? Things get wacky, and the central banks do wacky things to be able to push us through warlike environments.
You're calling this a warlike scenario because of what's happened with Ukraine and Russia? Or
no,
that's to come?
No, I am saying that the central bank treated COVID like war times. It obviously was a cold conflict, right? It wasn't people shooting each other and lives being lost in that sense, but the central bank responded like it was a war, like the ones that we read about. So there you go. That's my take. This is more like an economy after World War II than it is after, or I guess within the 70s.
No, but usually after a war, you've got a huge amount of GDP growth, and you've got a huge amount of everything is produced, and everyone's working. Everyone's.
Oh, you mean? Are you describing right now? You mean?
No, GDP is negative. That's the opposite of what's happening now.
But we just came off of what, Brad? What were the GDP prints before we just got these negatives?
I understand,
huge off a recovery.
That usually when you have a war, like those effects last for years and years and years.
Oh, brother, I'm saying it rhymes. I'm saying it rhymed. It's not congruent. But if we're going to make comparisons that are kind of senseless anyway, I'll compare after wartime, because our central bank responded to COVID like we were in wartime. That's what happened. So look, back to what's most important.
Are you going to show that like 45 times today in our call?
At least. I'm trying to get Paul Volcker to trend more. All right. Welcome to episode 22 of
No. Start over. We're 23.
Oh, is it 23? Whoopsie.
We had this conversation already today.
I know, but I thought it was 22.
You know how I get repeating conversations.
Okay, this will be, you know that black and white thing that they do, like take two? This is the new one. Take two. Welcome to episode 23 of Talk Your Chart. I am Marco Segrera here with the wonderful Brett Horowitz. Brett, how are you?
Good, Marcos. The last few days have been pretty rough. So what do you got?
It's been bad. Inflation, it was still lower, but not low enough, the market says.
Today, positive.
Yeah, it's lower. It's trending down month to month, but not what the market wanted to see. So we got extra bearishness. I think it's ultimately a little bit overblown, just because so much is already priced in. But who am I to say? So my charts today, yes, I did it again. I brought two charts, solely providing some perspective. We have clients who have been clients of ours for long periods of time, and we have clients who have been clients of ours for short periods of time. That's something we don't have control over. So ultimately, when we sit with a lot of these clients and we're reviewing portfolios or plans, you might have been a client for 15 years, you might have been a client for 5 months. Ultimately, I think we all wish that the clients that have been clients for 5 months had been around for longer. And I think what's happening right now, especially if you have portfolio reports that's showing a short period of time, you're getting really, really, really focused and just hooked in by the recency bias of how bad performance has been over the last 15 months, and especially year to date, where we've drawn down as far as 24%. We're off those lows, but we're still down 24%, right? So what do my charts have? I have two charts here for you, Brett. One of them is showing 10-year performance, and one of them is showing us 3-year performance. Let's start with 3-year first, because every 10 years, I get it, it's a really, really, really long time, 10 years, although in market terms, not very long. But let's at least start with 3. And what this chart is showing us is S&P 500 returns over the last 3 years have annualized at a bit over 11%. And that's not the index, that's the ETF. So that's including the cost, the underlying fund expenses. So you could have received that return, assuming you stayed your course and assuming you have a course. So why do we show that? To say, hey, look, returns don't come even. We know this. Brett, do you remember the percentage of positive outcomes that you get over a year of market returns?
You're saying 3/4 of the time market up, that statistic?
Exactly. You hit it on the head. So 3/4 of the time the market's up over a 1 year, over 12 months. Does that mean every single year? No, it means.
Well, that's what happened the last 4 years. You had 3 up years.
Exactly. You get that. So it stinks. It sucks to go through what's happening now and all the headlines, right, of what's going on are a ton. And I could give you easily 7 to 10 headlines of all the things that we have to look at and what could go wrong. But if we properly frame performance and we look at the last 3 years, even, you're annualizing at over 11%. And then let's look at 10 years. We're annualizing at even more than 11.5%. That's just looking at the US market. For a global investor, which our clients are, you're still looking at markets that are up over 5%. I'm looking at the 10-year now. There's another item I wanted to point to, which is currency, which is just a fun data point. But look, you're getting an international market over the last 10 years, annualizing, over 6%. US stocks annualizing over 11%. You have to be happy with that. And that takes into account all that's come. So if you benefited from markets over the last 3 or 10 years, that's kind of the point. If you haven't, that's not your fault, right? This is just what happens when you invest over time.
Well, to me, it was you hoped and prayed this would have happened, because for the 10 years prior to that, from 2000 to 2009, US did horrible. It was down for the entire 10 years, right? The lost decade, whereas foreign stocks were up nicely. And so we convinced ourselves, we told ourselves, we hoped it would happen, that, hey, you'd have this reversion of the mean, and the next 10, 15 years would be the opposite. And that's what's played out.
Yeah, we're due for a mean reversion, right? Because now it's 15 years of US outperformance. So who knows what that looks like? Obviously, everybody's worried about the recession that's happening in Europe and how Europe's going to respond to the natural gas issues with Russia. I think Russia looks real powerful right now. And in 3 years, they're going to say, oh man, we overplayed our hand, because no one's going to be wanting to rely on them anymore. But TBD, right? We'll see what happens.
Yeah, but let's not make the argument that just because Europe is going through a rough patch and GDP is probably going to be worse and inflation is going to be higher, that then leads to lower returns, right? Because you've got, as you said, things are priced into the market already. You're going to be paying lower price to earnings ratios to buy those stocks, to buy those countries. So it doesn't mean that's going to play out that way. All they need is slightly better results than what we think, and the opposite could happen.
I agree with you without a doubt. And sentiment is horrible in Europe. But look, if you ask me, like, make the bet, make the prediction over the next 12 months, European markets up or down, I'm going to say, down. Let's go with down, because there's a recession coming. And what's the line of sight for them getting out of this massively problematic energy crisis that they're going through? I have no idea. But a 12-month period, like we just talked about, is a really short period of time.
Well, but you're saying foreign markets down worse than the US. I mean, that's the real thing, right? If you've got equity money, you're putting either US or foreign or both.
No, I know. But forget even on the relative basis. I'm just saying, look at them in an absolute basis. Are they up or down? That's one thing. On a relative basis, I'd say US outperforms international over the next 12 months. But who cares? It's 12 months.
Right. I mean, Vanguard, I know, made a big call a couple of years ago where they said 2% outperformance per year over the next 10 years, foreign versus US. And so I would not be surprised that happens, because like you said, you've had so many years now in a row where US is being foreign, where the tide's going to turn at some point.
Yeah. So look, that's my chart. It's pure perspective. It's yes, it's crappy to go through what we're going through now, and the headlines are scary. But this is what markets do. You're compensated because you're taking risk, not because you're getting something that's consistent over time.
Okay. Well, I am going to make a bold prediction that is in line with probably the minority. But one of the things I found surprising recently was that in the second quarter earnings calls, okay, I think it was 240 out of the 500 companies in the S&P 500 talked about the coming recession.
Yep.
Right. For some reason, everyone seems to think this thing is coming, even though right now there's zero signs that it's coming. We just know that typically when the Fed raises interest rates, that oftentimes leads to recession. But to me, it's the equivalent of looking at a hurricane that formed off the coast of Africa and saying, let's go put up the hurricane shutters now because that's going to hit us. Right? We just don't know.
So the only thing, I get it, but if you're a CFO or CEO of a publicly traded company and you see PMIs, the purchasing manufacturer indices rolling over, you see some demand compression, and you see that you have to continue passing along these higher costs to consumers, you have to plan accordingly.
And you see the consumer willingly paying for those things right now. I mean, it seems.
Oh, I know, but BH, you gotta skate to where the puck is going, not where it is.
To me, it seems convenient that they put that in there. That way, if earnings get weak, you could say, look, I already said that that's because the recession is coming.
That I agree with that. You have to set expectations. That's what CFOs and CEOs do. This is also, look, what's the big problem with capitalism, public markets? That they're short-termism. They're living quarter to quarter. And that's what they do on these calls. But the earnings themselves are good, but that's all backward looking. So kind of who cares about what happened over the last quarter? All of the guidance, the forward guidance of how they think they're going to do, to your point, everyone's guiding down, and that's to set expectations. So I'm happy it's happening.
I'm going to take the opposite stance as the
opposite
minority.
Of what? Opposite of what?
And say the recession is not going to happen.
What do you mean not going to happen?
I'm going to show you a couple of charts and the reasons why some very smart people think the recession is not going to happen. I understand it's not the most common answer, but I don't think it's a conclusion that is written in stone that a recession will happen.
But Brett, so it's a recession is never going to happen again ever?
No, in the next year. Right? We're talking about the next year, not never.
So only 12 months. So if it happens in October next year, you were correct?
Well, look, the CEOs who are talking about recession are talking about within the next 12 months. That's what they're referring to.
All right.
Fine, so call it 2023. 2023. I'll put it all through the whole year.
Okay, whole year. Thank you. At least that's something.
So here is the first chart that is some of the basis for why some of the smart people out there do not think a recession is coming. So we've got two little slides here. One is excess of labor demand over labor supply. So basically how much demand you have for workers relative to how many workers are available, the supply. That's come down. You see the trend coming down the last few months. And then the right chart is the quits. How many people are leaving their job, which typically the more confident you feel about the economy, the faster. You're shaking your head already. I'm not done talking.
I'll debunk that in a minute. Go ahead.
The faster people quit their job, the more confident they are about the economy. So when people stop quitting or slow down their quitting, that means they're a little bit more pessimistic about where the world's going. So to me, why are those things important in terms of maybe helping us not to hit a recession next year? Because right now, the majority opinion believes that inflation is too big of a concern, and that if we don't have enough, if we you're going to have a lot of interest rates going up over the next year, you have a lot of people losing their jobs, and that's going to cause us to then people not being able to spend, and that's going to cause the recession. And what the people here are saying is that that may not happen because ultimately we don't have enough workers as we are. And so instead of seeing right now, you're not seeing unemployment go down, it's at the low level. So the argument is you're not going to see unemployment go up in any extreme case. You're just going to see wages come down. What do you say to that?
Okay, so look, that first one, quit as share of non-farm employment. Okay, got it. Quits. I get it. Why are people quitting? Because they quit and they go get paid a reasonable amount more when they go quit. Here's what's happening anecdotally. And I literally just had breakfast with a dude who owns a headhunting firm. And we were on the hiring committee, we talked about it. People aren't quitting because they're just getting offers that are bigger taking them back to their boss and getting paid more. Wages are still going up.
Mhm.
So as long as quits are there, and that's fine, it's still higher than above trend. That's not going to do anything until it moves. Here's why it doesn't, by those two charts, and I think just kind of don't matter. I love your charts, but I think they kind of matter because I think the bigger question is, can inflation get under control without the Fed causing meaningful pain, which always is an unemployment thing. It means people have to stop hiring, which will lead to firing. There has to be pain. The only thing that I think helps it, and the chart that you'd probably add to that, is a labor participation rate. As more people go back to looking for jobs, you would hope as labor participation goes up, that means unemployment goes down also, right? Because you don't have to fire people. And just by making the denominator bigger, you get a bigger unemployment figure, right? Because now there's more people looking for jobs that don't have them. So I think the labor participation going up is the best thing, because that can be kind of a good thing, more people looking for jobs without having to go through the pain of people getting fired, and you still get an unemployment rate that goes up.
Well,
But the quitters, I don't know.
look, I think the differences between last times we've had high inflation now are a few different things. Number one, expectations of inflation are very low. So you look out in chips, and you look on other things, and they're down in
That
the 2
changes
to
on a
3.
dime, but okay.
You don't have the worst thing for inflation is people thinking inflation is going to be worse going forward, because then you delay all your purchases because you think prices will be higher later. Or I'm sorry, you speed up all your purchases now because you're worried about inflation being higher later on. So people don't think this is a long-term effect. There's supply chain issues that are starting to ease themselves. You're seeing lots of commodity prices come down. It's not just oil, it's copper, it's gold, it's other things like that. What else? Excess supply is starting to come down. What was the last thing here? Yeah, the last thing was just the labor demand. So the Goldman Sachs person that I was reading an article about in the Wall Street Journal, and others have said that inflation probably is going to go up, but there could be a case that it goes up only very modestly, because as we said in other calls, every company is short on staff. And so maybe you'll have some, like you said, people come back to the workforce. Maybe you'll have some businesses that need to lay off, but ultimately, I don't think we're going to go from 3.5% unemployment to 5, 6, 7, 10 that we've had in other recessions.
Okay.
Who knows though?
Okay. So look, I can get behind that, because I do think it would make sense when we go into recession that it's a shallow one. And that's where I think it's important. Maybe we can throw charts about this stuff. Not every recession is made equal.
Right.
They're not all the same.
But we've also only had one situation really in past memory that had high inflation. And you'd brought up your wonderful picture, Mr. Volcker, who raised inflation. Show us again. There you go. That was one situation, the 70s and 80s. Before that, after that, we haven't had high inflation, right? So it's hard to say that everything now is what was happening then.
Yeah. You know what, Ross, sidebar, if the recession does happen next year. And wait a second, hold on. So we're going to go off the NBER call, right? The National Bureau of Economic Research, right? That's who we'll take our marching orders from. If they call it next year, then you have to smoke a cigar on this. You have to recreate this photo.
No, I'll hold the cigar. I'm not going to smoke the cigar.
What?
These lungs need to last for a long time, Marcos.
Oh my God. You're recreating this photo if the recession happens next year.
I got to shave my head too.
Volcker. We'll see. The only Fed chair that could dunk. The recessions are different. Yes, there's not a ton of comparison to inflation. When you have to go really, really, really far back. I get it. Things are different. I think when we do go into recession, I don't know if it's next year. I guess it definitely could be. It probably should be. Just get it over with, rip the Band-Aid off. The question still from our perspective and what our clients care about, are the markets going to find another low? Do they have another 15 or 20% to go? And that is going to be driven by the Federal Reserve.
If it goes from 240 companies saying recession to 500 companies saying recession, then you got to say everything's already built in, because every person is saying recession, including you. So I'm going to go on the record, say it's not going to happen. Everything will be all right. We will get through this. It'll be very different than the 70s and 80s.
But I'm saying the same thing, other than, yeah, we go through a recession. It's not like the recession happens and everyone is like gone.
I
You
don't think
live
we
through a
even,
recession.
yep, I don't think we'll even have one.
I think it would make sense if we get it next year.
We'll
The
see.
heck was I gonna say?
Put it on the list of things that we're betting on for next year.
Okay, I will. And you're recreating the Volcker photo. I was gonna say one more damn thing and I forgot it. I guess I'll have to save it.
Okay, next call.
All right, Brett Horowitz. Till next time.
Take care.
See you.